everybody, welcome to the Basis Points Podcast. I'm Kevin Flanagan, Head of Fixed Income Strategy at WisdomTree Asset Management. And we are excited not only for the topic, but for the guests on today's podcast as well. You know, one of the big items that get talked about in the fixed income arena is private credit, alternative credit. And we have the resident expert, Chris Acito, CEO of Gapstow Capital Partners, on with me today, and that's going to be the topic of our conversation. Chris, great to have you on board.
Kevin, always great to speak with you. Thank you for having me.
Absolutely. So, you know, I think it couldn't be a better timed topic for this discussion. Matter of fact, we had an article in the Wall Street Journal last week focusing on this exact topic as well. And what was interesting, the premise of the article was that you're seeing issuers kind of scramble to come up with an ETF in the private credit space. But Chris, we go back 3.5 years, it flew by. We've had so much fun this 3.5 years.
Indeed, Kevin. Yeah, that was, we were perhaps a little early with this idea that seems to be catching fire as we speak.
Absolutely. WisdomTree teamed with Chris and Gapstow, who have their own in-house GLACI index into this space, put it in an ETF wrapper. So as I said, this is an area, a solution, a strategy that WisdomTree partnering with Gapstow for about 3.5 years now. So, you know, definitely feel like we're ahead of the game on this. HYIN is the ticker, the WisdomTree Alternative Income Fund. So, Chris, I wanted to throw it back to you. Give us a sense when people are talking about alternative credit, private credit, make the distinction for us. What's the difference between that and, say, what we're used to, investment grade and high yield?
To talk alternative credit taxonomy is a dream come true, Kevin. Happy to do it. Hopefully I can keep it in under 3.5 hours. So very broadly, alternative credit in Gapstow's lexicon is debt or debt-based securities or investments that carry a significantly higher expected yield, return, and perhaps a little bit more risk relative to investment grade. Investment grade investing, at least on the in regard to bonds, are very low credit risk securities, let alone treasuries where there's no credit risk at all, but also high grade corporates or structured credit. Alternative credit, which really has come into its own as an asset class over the last 10 to 15 years, again, are those activities that carry a much higher expected return and yield. Within that, what are the categories that we look at? We certainly consider high yield bonds and loans. So those that carry 300, 400, 500 basis points of extra yield pickup relative to IG. There's structured credit, whereby somebody takes a pool of loans or bonds and creates different risk tranches within them, and the alternative credit world focuses on those higher risk tranches. And lastly, I would consider direct lending as the third category of alternative credit, where people are making loans that aren't banks, and those are sometimes called private credit loans, but they're there to do sponsor finance or real estate debt mortgage creation. Those, again, carry premia for the complexity or illiquidity or credit risk components that are, again, pushing those yields and expected returns above where IG would be. It's a universe that's grown in the U.S. From a much smaller base to now over $4 trillion in underlying investable securities.
So, I mean, that's fantastic. And, you know, one of the things when we were having these discussions a few years back, and what we really found advantageous and also something that provides, I think, a useful context for the end user, the client user, partnering with you all and using GLACI and making that into an ETF was that there's a diversified approach that, you know, you were mentioning different sources or issuers, say, in the private alternative credit space. But instead of focusing on just one area, within GLACI, you provide more of a diversified, I think, solution or strategy. Could you just give us a little sense of what exactly I'm referring to there?
Absolutely. So at the beginning, as Gapstow and WisdomTree were giving some thought to how to create an ETF packaged a collection of underlying alternative credit opportunities, the thought was not simply to allow us to invest in, say, broadly syndicated corporate loans, or simply mortgage-backed securities, or privately originated commercial real estate loans. Our thought was that we wanted to create a turnkey solution that if you were to put $1 in the ETF, that it would automatically gain exposure to a broad set of alternative credit opportunities, private loans, private credit, structured credit, and also high yield bonds and loans, but also diversified type by borrower class as well, not simply corporate borrowers, but household borrowers and commercial real estate sponsored borrowers. Those are all large portions of the economy that have different credit cycles into them of themselves. So the thought being to be able to package that diversity of borrower types was important to us as well. And so the index, which Gapstow is responsible for, is purposefully designed to pick 35 underlying constituents, all of which are listed funds that gain exposure to some specialized area within the universe I just described. And that allows us to keep diversified amongst the underlying borrowers, the instrument type, and lastly, within GLACI itself, all the underlying holdings are equally weighted, so that you're not gaining overexposure to any one underlying pool of those types of loans.
So what's interesting, I mean, Chris, you alluded to it before. You and I, over the last 3.5 years or so, we've had a lot of conversations. We've been doing webinars, presentations, things along those lines. And it's funny, we'll throw out a polling question and see how familiar is the audience, say, in this space, and you get varying responses. So I think with that in mind, within the last kind of segment here for this podcast, it would be a good idea. How should an investor look at alternative private credit in terms of their overall portfolio? What kind of a correlation? See, I mean, we started out typically saying, how does this differ from IG or high yield, right?
Yep.
And most people would look at that as being fixed income centric. Now, should we look at this alternative credit space as being fixed income centric? What kind of correlation is it to the ag? How should we use it in an overall portfolio?
Yeah. Well, I think that the alternative credit brings two or three unique and differentiating features to it. The first is that it produces a very high yield. And so if you look at the underlying index right now, the current yield, at least at the end of September, we estimated to be about 11.6%. And that's by virtue of the underlying securities and the underlying funds that HYIN and GLACI hold. That is appealing into and of itself, and some people like to create and consider an income-oriented portion of their portfolio, perhaps different than IG and different from traditional fixed income, where they might put very high-yielding investments. That fits within it. That said, because of the diversifying properties, the second feature, which is that between credit risk and other idiosyncratic elements of alternative credit investing, there's a diversification component to the product as well. And so some people actually consider having just a separate dedicated pool for alternative credit to make sure that it is sought after and put alongside fixed income, traditional fixed income, and equity and other asset classes, so that it stands alone and brings a substantial diversification benefit to the portfolio overall. Those are the ways at which people are thinking about it. This trend towards having a dedicated allocation to alternative credit started in the institutional world, where pensions and endowments began to carve out unique exposures to alternative credit. But I think that same trend is pushing forward as well into the individual investor market along with their advisor in order to make sure that the exposures are meaningful and substantial. One of the important features I think that maybe many in the audience aren't familiar with is that traditional fixed income gets its largest risk factor is duration, meaning interest rate sensitivity, because fixed coupons, changes in interest rates will have a fairly significant impact on valuation. A large portion of the alternative credit world, however, is floating rate. And so it is less sensitive than traditional fixed income to movements in interest rates. Again, that's one of the unique diversifying features of alternative credit, and arguably why it needs to be considered as a slightly separate asset class, where the primary risk you're taking are issues of credit risk and structuring risk.
That's perfect, Chris. I think, what we wanted to do today was to provide you with some insights into our solution and strategy here in this space for WisdomTree and partnering with Chris and the team at Gapstow. What is it all about? How to invest in it, how to use it in your overall portfolio. So hopefully everyone out there, you have found this interesting. Chris, I think we're going to end it there. Thanks once again for coming on. It's always a pleasure talking to you.
Thank you, Kevin. Great to be here. Hope that was helpful to the audience.
Absolutely. So everybody take care and be well, and we'll come back to you next week for our next podcast. And before investing, carefully consider a fund's investment objectives, risks, charges, and expenses contained in the prospectus available at wisdomtree.com/investments. Read it carefully.